shortly we're going to see diesel shortages. I mean, there's going to be no diesel, no aircraft fuel, no ship bunkers, no heating oil. All this comes out of refining sour crude, which is basically what we get out of, out of the Middle East. This is going to hit prices, consumer prices, very, very hard later this year. And in Europe, we can couple that with the drought, which means that crop yields have fallen to less than half of where they would be expected to be. And just to make things worse, Russia has managed, if you like, to stop all shipping going into Odessa and the other Black Sea ports which were under the control of Ukraine. So Ukraine can't export its grain anymore. So global grain prices are going to be rising quite sharply. I mean, this is everything. It's a perfect storm coming together for governments, for G7 governments to deal with. So, what happens? Well, we know what happens. They will have to print in their effort to stop their economies tanking. Put aside the inflation sort of argument. What that really does mean is that the purchasing power of these currencies is effectively going to be running into a collapse. I mean, the fact of the matter is that when it comes to funding the expansion of credit in the form of currency and bank reserves, this funding is running into a brick wall. I mean, you've got debt to GDPs throughout the G7, which average something like 120, 125%. I mean, there are outliers like Japan on the one hand, being 200 or 240%, however you measure it, and Germany, which I understand is around about, 75% now. But its economy is really, really struggling. They're in debt traps. So how do you get out of this risk? The answer is you get into gold. And I think we're at the point where the markets should be waking up to this. I mean, they should have woken up to it a lot earlier. I mean, markets are effectively broken. And as to the point as to whether this move up in gold, if you like, is the start of a new trend, the fundamental facts suggest, yes, it is the start of a new trend. Basically, not because of the merits of gold or silver, but because of what's happening to credit. It is entering a stage of, a period of collapse. There is no other conclusion you can come to.
Gold can climb alongside rising yields when investors are more worried about currency stability than they are focused on yield itself. Alasdair Macleod's point is that the usual inverse relationship between rates and gold falls apart once credit risk takes over as the dominant concern, which is why gold kept advancing even as the 10-year yield pushed toward 5%. The part that gets overlooked is what those elevated yields actually signal about debt sustainability, rather than just the opportunity cost of holding a non-yielding asset.
Okay, well, in times of relative stability, what traders will look at is the relationship between interest rates and the yield on gold, the yield being basically the lease rate. If the expectation is that interest rates or bond yields are likely to rise in the short term, then that disadvantages holders of gold because they're losing interest, as it were, on the currency. So that, if you like, in times of, let's call it normal market volatility, is the basic relationship that has evolved. However, if there is an increased risk in the value of credit, and by this I mean specifically currencies, then the relationship changes. And this is why when we came off the Bretton Woods system, we saw gold run from $35 to $850 at one stage between 71 and 81. And at the same time, the Fed funds rate rose from something like 5%. In fact, it dipped down to about 3.5%, up to around about 19.5%. So there was a sort of general correlation between rising interest rates, rising bond yields, and a rising gold price. But that was a time when there was, if you like, a growing and perceived risk to the purchasing power of currencies. And remember that we had inflation rates which were running far higher during the 70s too. I mean, we saw, believe it or not, the Japanese inflation rate in the mid-70s hit, at the consumer price level, hit 30%. So this is, that, if you like, is where the real difference is. Now, so what are people expecting today? Well, if you look at the surveys in America, and what America does, we all follow, let's face it. If you look at investor surveys in America, I think the two main surveys, one of which is, I think, University of Michigan is one, and the other one is the New York Fed. They say that consumers expect inflation to run to something between 3.7 and 4% by the year end, but in the longer term, they expect it to decline.
Higher yields don't automatically dim gold's appeal if the currency itself is losing credibility. Alasdair Macleod points to the 1970s, when gold ran from $35 to $850, even as U.S. interest rates surged toward 19.5%. That historical episode matters because it suggests today's investors might be forcing a normal cycle framework onto what's actually an abnormal, debt-driven cycle.
From those levels to around about 3%. They think that's going to be the long-run rate of inflation. So in other words, the suggestion is that the current level of the Fed funds rate is actually broadly sufficient to contain the effects of expected inflation. What we need, if you like, is the representative of all the commodities which are going to be going up in value, and that's gold.
Yeah.
I mean, if you look long term, the value of a basket of commodities valued in gold is pretty constant. You get commodity bull markets, which actually are bear markets in the currencies. All the people who talk about, Conrative cycles and all the rest of it, I mean, they miss this fundamental point. The world basically works on credit, not on gold. Even when credit is tied to gold as a gold substitute. But, if you literally, there will be some variation in the value of a basket of commodities, but mostly that comes from the interrelationship between currencies and gold, not from gold itself. You could buy, instead of gold, you could buy any sort of commodity, but it would have to be, a basket of them to get rid of the individual characteristics. What happens if, let's say, suddenly nobody wants magnesium? The price would collapse. They find a substitute for silver, complete substitute for silver, and let's just dismiss the monetary argument from it. It would collapse. What happened to silver in the 1870s was when Europe went off silver standards following the Franco-Prussian War onto gold standards. The silver ratio rose.
The real benchmark to watch may not be inflation itself, but the cost of an entire commodity basket measured in gold terms. Alasdair Macleod's argument is that commodity bull markets can really be currency bear markets in disguise. Gold stays relatively steady against that basket while the currency loses ground. Seen that way, gold's rise isn't the story so much as the decline in currency purchasing power underneath it.
It shot up from, sort of 15-ish to, sort of 20, 25. Why? Because, the monetary value went out of silver. It wasn't demanded. It wasn't demanded for its monetary qualities anymore. So, the point I'm making is that gold is representative of all commodities put together. Gold is the most convenient way of buying that basket. That's what it amounts to. You can buy silver and get a more volatile version of it, but then again, you're getting specific silver risks. So anyway, that's where we are.
Yeah, and it seems like South Korea is also getting that message now, because after 13 years, they will be back on the market and they intend to buy domestically produced gold. And they cited geopolitical uncertainty and the desire to de-dollarize and diversify their reserves as reason. How do you look at that?
Well, yeah, I mean, I think you have to bear in mind that Korea is not all that far away from China. They talk trade a lot between, Korea, China, and also Japan, China, and, at the time of Trump's Liberation Day, you remember when he held up all the, these tariff boards and all the rest of it? That was April the 2nd last year. One of the things that China did was it moved very, very quickly to try and develop the existing talks, trade agreements between China, Korea, and Japan.